Hi there, this is the Mutual Fund Corner. I'm Mangla Malu. With me is Ekta Batra. Like every Tuesday and Thursday, we answer all your mutual fund related queries. And just as we speak, we got some data coming in from the December equity flows. Looks like it is a disappointment as far as the flows are concerned. But the only heartening fact is that the SIP continues strong. So 0.5% growth or thereabouts seen in the SIPs. Check on the markets. We've seen a bit of a recovery on the Nifty. Narrow range trade. We've bottomed out at 10,750 for the last two trading sessions. Closer to the higher end of today's narrow range, that is. But the star recovery has been seen in the Nifty Bank. At the high point of the day, 250 points from the lows for the Nifty Bank, led higher by SBI, ICICI Bank, and now the private Nifty Bank, the private bank index has moved higher too. Hi, Ekta.
Hi, Manglam. Yes, absolutely. And for the Nifty, however, it's just about a consolidatory kind of day that you'd have to say. So the Nifty is just about higher by around 12 odd points, Sensex up around 72 odd points. So yes, recovered from the day's low, but no real big movements which are coming in today. So just a bit of a breather of a session, with the Bank Nifty also just higher by around 0.3%. A lot of stocks buzzing around. Sun Pharma, for example, is up around 3 odd percent, top gainer on the Nifty. We have Eicher Motors, which is up 2.5 odd percent, so doing well for that stock as well. Let's take you through all of the top stories we're tracking then this afternoon, and then we'll get answering all of your queries as well. The Lal Street sees a range-bound trade on thin volumes. The Sensex and the Nifty trade with minor losses as direction from US-China trade talks, global cues and upcoming earnings is awaited. Pharma and auto stocks gain.
Bandhan Bank and Group Finance fall in trade after Bandhan Bank announces the acquisition of Group Finance through a share swap deal. HDFC to apply to RBI to hold 15% in the merged company.
Supreme Court ruling impacts stocks. Monsanto gains after the Apex Court rules the company's patent on genetically modified cotton seed is valid. Competitor Kaveri Seeds falls, while it's a relief for Vedanta after the court refuses to stay the NGT order directing reopening of the copper smelter plant in Tuticorin.
It's a setback for the government after the Supreme Court sets aside the CVC order relieving the CBI Director Alok Verma of active duty. Says the government has to go back to the selection committee for any decision. Also adds Verma cannot take major policy decisions till the selection committee meeting's outcome.
And the data for December inflows into mutual funds comes in. Over 21% drop in equity schemes. Equity ETFs strong, while liquid funds see big outflows again.
All right, and it's been another subdued year for Indian real estate. After a promising start, it was subdued by the liquidity crisis that happened just in the previous quarter. That's the word coming in from property consultant Knight Frank India in their report in the second half of 2018. Kevin Lee, our colleague, is here to take us through some of the highlights. Kevin?
Keep in mind, it's been a difficult few years for Indian real estate, mostly because of black swan events, starting with demonetization, going on to the sentiment shock that was GST, and finally the establishment of the Real Estate Regulatory Authority. This year has been no different. Signs of recovery were there early on, but because of that NBFC liquidity crisis, those have been subdued. All things considered, not a bad half. The second half of 2018 saw launches up 119% over the second half of 2017. Sales were up only 10%, so you can see how disproportionate that is. For the full year, launches were up 76% in 2018 over 2017, where sales were up about 6%. Talking about unsold inventory, there's some good news there. It's dropped 11% to 468,000 units from over 5 lakh units. The problem is that the age of that inventory is going up, so getting rid of it might become a little problematic. At the current pace, however, it will take 10.2 quarters to sell all existing inventory. That's down from over 11% last year. Knight Frank estimates that there have been early signs of recovery, but those were subdued, like I said, because of the NBFC liquidity crisis. Let's talk a little bit about pricing. We've seen a 7% drop in weighted average residential prices for the city of Mumbai, so that's good news if you're looking to buy a house. However, keep in mind that data for individual micro markets is likely to be different. NCR and Bengaluru saw very modest price increases, about 2% compared to the second half of 2017. The house price to income ratio is lower than it's been since 2010 for all of the 8 top markets that Knight Frank tracks in these reports. Let's also talk a little bit quickly about commercial real estate. We saw 18.7 million square feet of new completions, which is 49% higher than the second half of 2017. Vacancy levels have risen to 12.3% from 11.6%, so that shows that there is healthy demand out there for Grade A office space. Bengaluru, interestingly, has eclipsed Mumbai to become the top destination for commercial. BFSI especially is driving that growth, and co-working spaces remain an interesting trend that Knight Frank continues to point out in these reports. So all in all, not a bad year for Indian real estate, but could have been much better if not for the liquidity crisis. Back to you.
Okay, all right, Kevin. Thanks very much for getting us that update. But we need to get back to our queries this afternoon. Joining us today, we have Feroz Aziz of Anand Rathi Financial Services to answer all of your mutual fund questions. Feroz, hi. Welcome to the show. Well, let's get going in terms of the first question that we have. Thomas Kuruvilla calls us from Kerala. He has investments in NFO and wants to assess his portfolio as of now. Well, Feroz, what would you recommend? Okay, Thomas, in fact, Thomas is with us. Thomas, hi.
Hi, good afternoon. Thank you for having me.
Afternoon. Yeah, go ahead.
My query was regarding the IDFC Sterling Fund, which I invested in at the time of the NFO. It's now, I think, more than 11 years after that. So it's not very clear to me what kind of a fund it is nowadays. So my question was whether I should look for some other fund.
Okay, Feroz, go ahead.
I think, Mr. Kuruvilla, point one is now that you've stayed in an NFO for that long, which I think is good, quite a few of them actually exit NFOs much before you do. So point one, ideally going forward, don't buy NFOs because you would rather prefer those funds which have a track record because there's an established style which you can analyze before you make a choice. So that's point one. Point two, coming back to the specific NFO which you invested, that's IDFC Sterling Equity. I think the fund is not doing too well because there has been a fund management change. There has been the CIO movement in that specific fund house. So I would recommend you to go for more conventional schemes, which are the large cap schemes in more stable fund management teams. So let me give you one recommendation. You can look at Aditya Birla Frontline Equity, which is a very good fund, and I think Mahesh Dangi is managing it, and it's a large fund with immense track record of a good risk-adjusted return. So that would be the change I would recommend. Point three, one thing which I should obviously tell you is make a core portion of the portfolio. All these strategies could be the peripheral, but not having the core before you venture into something unconventional is not advisable.
All right, Mr. Kuruvilla, hope that advice works for you.
So what exactly?
Yep, sorry, go ahead.
What exactly is this fund, this Sterling Fund? What does it invest in?
It invests in equities. It has about 55 to 60% in large cap equities, and there is small cap to the extent of 25 to 30%, mid cap, and then the rest of it is in small cap. So it's largely a multi-cap fund and has weightage towards the large cap largely. So it's a well-diversified fund from a multi-cap perspective.
Okay, thank you, sir.
All right, Mr. Kuruvilla, thank you so much for calling us with your advice, and we hope with your query, and we hope our advice works for you. With that, we have another query coming in from A. Narayani, writes to us from Tamil Nadu. She plans to invest in mutual funds, wants to know which funds are suitable for her. Feroz, before the recommendations come by, she is 47 years old. We don't have a detail of what her profession is. But for a person who's 47 years old and planning to invest, what should the person conventionally do?
I think if you're 47 years old and if you're saving for retirement, I would assume that children would be studying and you would have already figured out what the education plan is for them, if not they having taken a loan for themselves. So you should have at least 70% of your money in equity because you will still have 10 years, 12 years of working life, and that money accumulated in this decade or more will need to sustain your lifestyle for the subsequent 2025, which is the life expectancy of a normal person. So I would recommend 70% in equity. In the equity category, let me recommend some schemes which are contemporary and have a large hope that they would do well over the next 3 years, not just their past performance. So Mirae Asset India Equity Fund, Reliance Large Cap Fund, SBI Focused Equity. These would be the 3 large cap funds. And then you have a multi-cap fund, which is Kotak Standard Multi-Cap and Canara Robeco Emerging Equities. These are the 5 funds you can look at, Narayani, from the equity perspective. On the debt side, you can look at ICICI Regular Savings Fund and Franklin Dynamic Accrual. These are 2 debt schemes and 5 schemes which I just mentioned on the equity category in a proportion of 70-30 should be a good stable portfolio for you to hope making 12-13% and upwards.
Firoz, would your recommendations change if the assumption was that she wasn't working and it was her accumulated savings?
Yes, it would. It also, one is, what is your recurring investment? If you've already accumulated this corpus and now you're wanting a withdrawal, then the debt portion would move to 50-50. And then you can take your regular income from the half portion of your portfolio in the form of a systematic withdrawal plan so that the tax efficiency is maintained for these inflows which will hit your bank account if you're eating into that corpus.
Okay, all right. Well, we have another query now, so let's get to that. We have Arun Kumar who writes to us from Chennai. He wants advice on building a portfolio with a 20-year time frame. So that's the details that he's provided us. I don't think he's, I think he's a, based out of Chennai, professional, 34 years old, and he's an NRI. And he continues to be in that status for 4 years, and therefore, and then after that, he might probably come back to India. As of now, he could do around 10,000 per month in terms of investment, and or I think 3 lakhs in lump sum investment. So totally, he has a 20-year time frame in terms of an investment and building a portfolio.
Yes, I think it's very nice and heartening to hear people wanting to invest for 20-year time frames. Ideally, a few years back, an Indian mindset would be 2 years is long term. Now, 20 years is reasonably good time frames where you can get the benefit of wealth creation rather than just money making. So point one, great. And the next part is if you're an NRI and if you've gone offshore to earn money, then it makes sense for you to accumulate Indian corpus, Indian rupees, and grow them well so that when you come back, it will be well worth having traveled that far to earn yourself. Coming back to the investments of 10,000 rupees a month, the schemes which we mentioned to the previous caller, Narayani, I think are relevant to you as well because the time frames are reasonable. So Mirai Asset India Equity Fund, Reliance Large Cap, SBI Focused Equity, Standard Multi-Cap, Kotak, and Canara Robeco Emerging Equities. These are the 5 good equity funds from a 2019 and beyond perspective. I would say SBI Focused Equity is a unconventional recommendation. Has only 23 to 24 stocks in the portfolio. This category was newly carved out by SEBI on 1st of April 2018. I think that will have a little higher risk reward, and the risk will get mitigated because of your time frames and give you that fillip on your portfolio. I think since you're just 34, as you've written into us, I think you can take additional risk, and since you're investing in the systematic format, the risk automatically gets mitigated. So 0 debt for you, unlike the previous caller.
Okay, 0 debt in terms of investments, just 100% equity. All right, Firoz, so that's on the query that we got in. Just want to point out that for the Nifty, in fact, we've recovered back to 10,800. So there's been a pickup, especially in the Bank Nifty. So if the intraday chart of the Bank Nifty comes up for you, you'll basically see that there's been a spike up in the Bank Nifty itself. As you can see on your screen, we have ICICI Bank, which is really leading in terms of gains. That stock is up around 3% ICICI Bank intraday chart should come up for you. You can see that spike up that we've seen. And State Bank of India also not doing too badly, up around 2.6%. Yes Bank, also a Bank Nifty constituent, is up around 2%, a little more than 2%. And IndusInd Bank, which comes out with numbers tomorrow as well, that stock not doing too badly, up around 1%.